Welcome to the Trading Panel, the show where we get traders of all different styles, backgrounds, and opinions, and we smash it all together and see what comes out. Sorry, guys, it's early for me today. My brain is not working quite yet, but we'll get there. So, welcome to the Trading Panel. Oh, my goodness, what a start, Jason, eh?
I love it. I love it.
Can only get better from here.
Yes, I also have to give it up for Andrew. One, he always does a great job helping us all put this together. And two, he's a great partner with me on this project. And three, he has to get up very early to put this together with us. So, we really appreciate that, Andrew.
My pleasure. I love doing this. And by the way, Jason, I just want to start with a congratulations to you because you released a ripping, absolutely fantastic interview couple of days ago with Thomas on your Against All Odds Research channel. That's right. Yeah, Against All Odds Research. That was a great interview. Well done, man. That was awesome. So
thank you.
I recommend everyone go and check that out if they haven't seen it yet.
Thanks for connecting us. Yeah, it was so cool, and it was great to just have I mean, we all know, and that's something we could even talk about here, is that trading is it's a deep game. And like, if you ever want, I always say, and I'm sure traders have always said this for all time because my uncle used to say it to me, which is, if you ever want to learn the most about yourself, trade, because you'll learn all your bad tendencies, your character defects, everything, that those all come through trading. So it was very cool to have a very candid conversation about that. I hope everybody checks that out because that was a great interview.
Yep, I'm going to post a link to that in the chat. People can go and check it out. Not right now, after this, because we've got some fantastic guests today. Jason, do you want to take it away while I get this link in the chat before I forget?
Yeah, so, the trading panel is basically for Larry and Steve, their new guests on here. So the trading panel, Andrew and I, and also Steve and I have talked about this, where you go on these spaces from time to time or other channels, and you end up seeing these people, and you're having conversation with people who aren't really in the markets and they don't know much about trading, and you're listening to them talk, and you're like, well, you don't really trade these markets. And so our idea that Andrew and I had was really to try to stick this into the realm of trading, find people who actually have traded in these markets, understand these markets deeply. Even if you are an analyst, you really do understand this to a very deep degree, and all the tendencies that are behind it, whether you're systematic, whatever it is, understanding those things. So, it's awesome to have you guys with us today. So Steve and Larry, Larry, to kick that off first, trading being such a, it's such a huge thing, right? There's so many different avenues, especially when you're a new trader. You're looking on Twitter, you see everything out there, under the sun, and different ways to trade. So for you, I've always liked your style because it's very simple. Like, you have a way of simplifying trading strategies in such a great way. So what's the main thing you look for when you're looking at a chart to try to figure out if you're going to buy or sell something?
Great. Thank you. Thank you, Jason, for the introduction. Thank you, Jason and Andrew, for having me on. So the first thing that I look at, and what I've done over the years, is I've tried to simplify, but I just look at the basic chart trend. So I'll pull up a daily chart for a 1-year time frame, and I'll just look at the chart trend. And ideally, I want to see a chart that's in the upper right-hand corner. And then I go from there. There's some variables to it, but the key thing is I'm looking for an upper right-hand corner potential breakout chart.
No, that's perfect. And so, I mean, the thing that I think is important in that sentence for everybody to kind of pick up is the fact that as traders, like, sometimes you make things so complex and so hard to understand. And it's like, for me, myself, and Larry, I'm just really looking at the trend. What's the trend? Are we breaking out of a base? Are we extending, basics? You don't have to get too in depth. So, and then getting to, what's your favorite type of indicators to diagnose trends?
So I use moving averages quite a bit. And what I look for is ideally 4 rising moving averages. So I use primarily the 20-day, 50, 100, and 200-day. So the perfect scenario for me is to have those 4 stacked on top of each other, and then they're all rising. So if I see that, that tells me I've got an uptrend really on 4 different time frames.
Nice. So Steve, you're also in the category, and that's kind of, Andrew and I were talking before this, and I was like, well, we got 2 technical traders on here. We could talk technicals all day with both of you guys. What do you look at for, Steven? You know, like you're also a person who looks at the markets through a technical lens. So what do you look for?
I love that Larry's price only, and we're very similar. Look at some momentum indicators, relative strength also, but that's just price benchmarked against something. Right now, I think we pay attention to different patterns in different environments, right? And for the current bull cycle, it's all about these big rounding bottom reversals, right? Because that, to me, you're catching a stock just as it's entering a brand new primary uptrend, right? When that rounding bottom completes. So if you could buy any of these clean textbook bullet or bearish to bullish reversal patterns just as they're completing, I think you can ride those trends for the longest, right? For the whole cycle. A lot of them you could ride back to prior cycle highs. If you look at something like small caps, IWM, it has that shape to it right now. I think it's a really good example of what I'm talking about. But I'm going back to the well for this same pattern over and over and over again. And that's, I guess, that's what's really been working this cycle.
Consistency.
Yeah.
So that's what I see over and over again, you know, no matter whose strategy it is, like and that's the thing. A lot of the people who end up watching the show and the channel, they're new traders trying to figure out how to trade well. And you'll see them jump from strategy to strategy to strategy. What I hear from both of you guys is like using these consistent styles of trading, you're able to find things to buy, find things that make money. And so getting into that, you know, how important is relative strength in kind of finding, you know, a sector to be in or a stock you want to buy?
Very. Right. You always want to be in the leaders. You want to outperform. If you're trying to generate alpha, which we all are, then you got to be in the best stocks. And I think, you know, really since October of last year, and some areas gave back some while others have kind of stayed strong, breadth has really been expanding. And a big knock on the market most of last year was it's really thin. And it was, right? Mega cap growth, large cap tech got kind of all the spotlight last year. Industrials were working really well beneath the surface, but now we're seeing groups like materials, financials also join. I think small caps are going to have their time, right? Speculative tech. I think the biotechs are finally going to break out. So there's just more and more opportunities everywhere. So it's really a stock picker's market. You could find pockets of relative strength almost anywhere, even real estate, right? So I think, yeah, just benchmark against the S&P 500, and you want to see a trend reversal similar to the one that I'm talking about on an absolute basis that we keep buying. You see a shape like that in the relative trend, then it indicates that you can expect this stock to outperform over longer time frames.
Nice. So Larry, you know, you get into a market, let's say it's very choppy, you know,
Right.
2018 is a great example. And you're kind of getting chopped around with all these trends. And this is a question that comes up a lot because people think like, oh, well, I have to change my strategy or anything. So I'll pass it to you. You know, do you feel like you need to change strategies every time, you know, the market's not conducive to your trading style?
You know, it's a good question. You know, for me, the answer is no. And the reason is that I'm really good at my strategy, but I'm not really good when I try to deviate.
Yeah.
You know, it's a lot like in football. If you're a running team, and then you try to throw the ball 60 times a game. So what happens is I can usually find an uptrend. And to Steve's point, relative strength is extremely important. And I'll often use relative strength as a tiebreaker. If I'm looking at a few different sectors or a few different charts, I'll often go, if everything else is fairly similar, I'll often go with the higher relative strength chart. But no, I don't think that a trader should change strategies. I think if the market's not conducive to what your strategy is, sometimes you have to just sit back and wait. Now, a lot of that's based on time frame, because if somebody's a day trader or a swing trader and they're looking to, you know, they need to make money every day or every week, then it can be a little bit more difficult to sit out. But I think for a day trader or a swing trader, it doesn't really matter, especially for day traders. It might not matter too much what the market environment is, because they can usually always find some volatility somewhere. But for myself as a longer term position trader and a trend trader, you know, it's like 2022 was a difficult market for me because a lot of breakouts failed. There weren't a lot of trends unless it was on the downside. So we went through 2022 about 50% cash on average. And for me, it's just better to wait until the market comes back to my style. But there's usually always breakouts, like Steve was saying. Maybe small caps break out, maybe real estate breaks out, maybe biotech breaks out. It doesn't really matter to me what the sector is. It will go wherever the breakouts are, and if it's small caps or gold or biotech, that's fine. But we'll find those breakouts.
No, I love that. I think that's really important because so many people get so stuck in that, and it's something that comes up a lot, which is especially with clients. When you manage client money, like I do, you run into clients are upset at certain points, and they're like, well, like you're having a rough period. Why don't you change your strategy? And you just can't change your strategy. One, like you have to, just like you said, that's a great analogy, and I've actually never heard it said like that. But I used to play basketball, and like I'm a point guard. And understanding like I can't be a center like that's insane. That makes absolutely zero sense. So once again, it's the same thing. Like I know I'm not a day trader. I know I'm not going to make any money in that short-term style of strategy. So Steven, you trade all these different markets and you trade options on a lot of them. And I think something that, did come up to me today, which it's funny, it's kind of a different question than we usually get, but what are you seeing? And you're a good person to ask this because you're always coming up with ideas. Are you seeing any areas that you would say is a great place for an options trade? The answer also can be no.
I think particular patterns lend themselves to different options trades. So let's talk about one we were just talking about on our analyst call. If you look at a chart of something like Square, I guess they call it Block now. Ticker symbol SQ, pretty clean, well-defined base, right? You could see the multi-year highs around 90. I would call that the base breakout level. However, we're trading at 83 today. This base is not complete, right? For me, this pattern is still messy, sideways, trendless, and probably a good chance that this could pull back and correct before we finally get that base breakout. You can put a call calendar spread on something like this, right? And then you can cover one leg of it once the base breaks out. So you could do different things with options based on the pattern. Another one I like is like a structural base breakout, Micron. Everybody's been talking about this breakout in Micron. It's got a multi-year base breakout. And if you zoom way out like 20 years, it's a dot-com bubble base breakout. We would just go long leaps, really long dated calls, right? Because that's a different pattern. And that dictates a longer time frame that could be slow to start with maybe some false starts and whatnot. You go way out, you get some leaps and hope that the stock has a nice reaction leg higher once the breakout is finally done and it's on to its next level. So that's the nice thing with options. You can kind of match them to the pattern of the price structure.
No, I like that. And I like the teaching lesson on there I think is very important because, when you think of things in ranges or high volatility or low volatility, like that's something that you always have to take into play when you're trading these option strategies. And also, something you and I have talked about a bunch of times, Steven, what are you seeing right now in the market? We're kind of seeing all this kind of shift at the moment. We're seeing the energy start to pick up. Industrials have been raging for a while now. Materials are finally starting to pick up. Are you kind of seeing a regime shift at the moment where we're kind of seeing some of these other things take over?
So we had David Lundgren on the show this morning. It's always, so great to talk to. He was kind of pointing out that it's not just cyclicals now, right? Materials, industrials, financials, energy, but really it's been cyclicals or offensive risk on groups the entire time. Sure, everybody's talking about and thinking about leadership from tech. But when you go down the cap scale in technology, small cap tech has not been great. Mid cap tech has not been great. Industrials, small caps have been fantastic. Mid caps have been fantastic. Large caps, mega caps have also been excellent. Right? So Dave was kind of pointing out, like, everybody's talking about this rotation now, but it's really always been the case that the most cyclical groups from any sector, so that would include stuff like home builders or semiconductors, right? But also things like copper stocks and steel stocks and energy stocks, oil and gas, The financials have been really good. It's kind of making the point that they've been there all along. I do think it's happening in a more pronounced way right now. If you look at some of the relative trends, XLB SPY, XLE SPY, right? So that's energy or materials, large caps, relative to the broader market, kind of hooking higher back into a range, look ready to really outperform the broader market right now. So yeah, I think so. And I think for the rest of this year, we're going to be talking a lot more about names that we haven't been talking about buying, in the first half of this bull market.
And Larry, and also feel free, either one of you guys, if you guys want to jump in on anything, just passing that same question kind of to you. I know you follow the trends. Are you seeing breakouts in different areas in this kind of rally that's been so thin and tech based? Are you seeing it move into other areas?
Yeah, I really am. I'm looking at the charts right now for the S&P sectors, and materials are breaking out, XLB, energy's breaking out. Really, everything's breaking out other than, for the most part, real estate and utilities when I go through these charts. But, to Steve's point, cyclicals have been following through. Industrials and financials, I think, were early first leaders, but now we're seeing RSP, which is the equal weight S&P, recently made a new high. Mid caps, MDY, that recently broke out to a new all-time high. But yeah, materials are breaking out, steel stocks, copper stocks, energy stocks. It's, for a while last year, it seemed like it was technology, the NASDAQ 100, and communication services.
Yeah.
That was really, those were the biggest market caps, but some of the other sectors hadn't turned around. And now I think the most bullish thing is that all of these other sectors have turned up and are breaking out, because if we're looking for a sustainable bull market, it needs to be most of the sectors participating. And that's what I'm seeing right now.
I think, Larry, would you say it's fair? We're moving from an environment where most stocks were not outperforming the major averages to an environment where most stocks probably will be outperforming the major averages?
I think that's very possible. Yeah, especially when you see RSP, which is basically the average stock, when you see that start to break out to new highs. Yeah, I think it's very possible that the average stock could beat the S&P this year, especially if the mega caps, if they take a break. So, obviously the mega caps are very split right now. You've got Nvidia has been very strong, but Tesla and Apple have been very weak. So yeah, there's a good chance that the average stock could beat the index this year.
We use, just like you're saying, S&P 500 equal weight. We use the value line a lot of times as a representation of what most stocks or what the average stock is doing.
Right.
There's like 1,700 tickers, like 90% of the U.S. trading volume. So it's a really broad index. It's just completing a trend reversal, like textbook rounding bottom reversal. So to me, I feel like while for the best stocks, for the leaders, it might be later stages of their runs. For most stocks, they seem to just now be transitioning from a sideways trend to an uptrend. Sure. I think for a lot of these names that, they could have legs.
Yeah, I agree. And I think that's really constructive because, for a long time there was was it 5 stocks? Was it 7 stocks? Whatever. But really now it's hard to make that argument. I mean, the New York Stock Exchange Index made a new all-time high the other day. I think that's 2,300 securities or so in there. So yeah, I think it's very constructive, because if we're going to get the S&P, it's 52 and change right now. If we're going to get the S&P up to whatever, 55, 56, whatever the number is, it's got to be, from the bottom up, I would think. And yeah, so it's very constructive.
Yeah.
So the question that came up about that was, what is the value line for people who haven't read what is it, Marty Zweig?
I think it uses it's like geometric average. I don't know what the hell that means, but it's basically an equally weighted index, 1,700 stocks. I believe it's North America, so it does include some Canada. But the most important part for me is I think it's like 90% of U.S. trading volume, or similar to the Russell 3000, which is like 97% of the investable U.S. equity market. It's something like that. So we use it as just information for what most stocks or the market is doing. I think the S&P 500 and the cap weighted averages tell you how most people's portfolios are doing, or
Right.
it tells you about, you know, the wealth creation from the current cycle, right? Because it's a cap weighted world that we live in. But if you want to know, hey, how are most stocks doing? You want to look at something like the value line, or like Larry said, an equal weighted index, not something cap weighted. So it's an information index for us more than anything.
Yeah,
Yeah, and I think-
RSP, when you look at RSP right now, which is the equal weight S&P 500, you know, it's got in the top holdings are Archer, Daniels, and Freeport International Paper. You know, these aren't the Magnificent Seven,
Right.
and that's breaking out of a 3-year, 2.5-year range to a new all-time high. And some of the monthly momentum indicators are just turning up on the chart. So I think it's a very, very bullish setup that you've got in the average stock right now for sure.
Yep, with you.
So there's another question on here that I think is really interesting, and this could turn into a bunch of conversations, but I think it's a thing a lot of new traders would have this question. And so Andrew, the one is by saying how to decide the time frame. For
Yes,
example, if I choose 30 minutes or 1 hour, then I would miss the action because most of the market could be pretty quiet all day and I would miss the action. So how do you decide your time frame that you trade?
Who's that for?
Yeah,
Either one. I think it's for any.
So I'll start because it's so I don't do any intraday or any day trading or swing trading. So I'm not, you know, it's not a good question for me. I will use the daily charts and some shorter term indicators for entry signals. You know, if I see a stock that's in an uptrend, but I'm looking for a good buy point. But as far as intraday, I don't do any intraday, so I can't really answer.
All right, I'll take a shot at this. How do I determine time frame? If I'm buying the resolution of a bull flag or a pennant in something that's already in a primary uptrend, I'm probably say I'm going to do it through options. I'll usually always be in common, and then I'll go to the option market if I want more leverage or juice, right? I will probably go, depending on the implied vol, just naked long calls and go out, I don't know, a month. Because a bull flag is a short term, it's a tactical pattern. It should resolve in a matter of weeks and then see a reaction in a matter of weeks, sometimes shorter, right? If I'm buying a primary trend reversal, some of these big rounding bottom patterns, like the square calls that we were talking about in our analyst call, or buying the trend reversal in square when it happens, say above 90, probably go out to September. Maybe it'll start as a call calendar spread and end just long calls, right? So yeah, we'll do things a little bit different, and we'll let the time frame be dictated by the pattern, the chart structure. With that said, 30-minute charts, 1 hour charts, I'm not finding setups on intraday charts at all. In terms of finding charts that I want to buy, I'm not going to any time frame shorter than 1 day. However, once I've already decided this is something I want to buy, I will dabble into a 15-minute chart to execute and make my entry. But that's it. I'm finding setups. I'm finding the charts that I want to be buying, mostly, pretty much always on daily charts. I'll zoom out to a weekly and a monthly every now and then, but pretty much just daily charts. And my time frame is a matter of weeks to a matter of months. Sometimes I'll get long something with the plan to be long for the entire cycle, however long the cycle is, right? And it depends on the chart structure, really.
No, I like that, and I think it's it's a question. I think it comes up a lot, and you also added about missing the action. Like if I'm more risk adverse and want to use a tight stop loss, would it make sense to use a shorter time frame, like 5 minutes? The question that I see in this really is, one, for me, I'm probably one of the most long-term trend traders in the commodities market. I use weekly closes to give me buy and sell signals. I can tell you that when I was first starting out, I think, and a lot of traders do this at the beginning, they go from a 5-minute chart, they go to a 10-minute chart. or they look at like a daily chart and go, oh, this thing looks great, and then they go like, oh, it looks bad. Oh, I need to catch the bottom. The 1 day looks bad. The 1 hour looks bad. The 30-minute looks bad. But hey, the 5-minute chart looks pretty good, so I'm going to buy this. You know, most importantly, like that sounds insane when you think about it. Like as long as we've been trading, but for the new trader, they do that stuff all the time. So it's, you know, really diagnosing the type of trader you want to be. Like, are you going to be long term? Are you going to be short term? Then figuring out what time frame you really make your decisions off of. You know, you want to have like a couple different trend indicators. You know, your primary trend, your intermediate trend, your short term trend. And that could be, you know, like a monthly chart. For someone like me, it's a monthly chart might tell me a primary. A weekly could tell me the intermediate trend, and a daily could tell me my short-term trend. But for somebody, you know, in a more shorter-term time frame, you could even do something like a daily being primary, go to a 4-hour for intermediate, and even shorter for short-term. You can do this a bunch of different ways, but really the main point is, and the most important part is, if you're making trading decisions, figure out the exact time frame you want to be in and how long you're going to hold those trades. And then the time frame also has to match your trade length. You know, if you're trading something like, you know, you're trying to trade something in a, you know, 1 year time frame, trading off a 5-minute or 30-minute chart makes zero sense. But if you're trying to trade something like in an intraday time frame, yes, maybe a 5-minute or 1 minute chart makes sense. You know, the one thing I do find is, like, most traders when they're new, is they really try to be way more short term than they need to be.
Right.
You know, you want to try to maybe extend your time frame just a little bit, and that might help you more than anything else. Because when you're trying for such short term moves, like, you're just, oh man, this didn't go my direction in 5 seconds, and you're out, and your stop loss is super tight. If your stop loss has to be that tight, maybe take the positions down. There's a bunch of different things that are really important. So that gets to a good question for you, Larry. You know, you being in the business for so long, you know, how do you manage risk, and how important is managing risk to your trading?
Oh, it's the most important thing, because if you don't manage your risk, you've got to find something else to do. You know, if you lose all your money or you lose too much money. So I do risk management every day with every position. So basically it starts with my position sizing. So when I go into a position, I always assume that I'm going to get stopped out. So I just assume that any trade that I take is going to get stopped out for any reason. There could be a headline, there could be, you know, an earnings miss, whatever, right? So what I do is when I take my position, I size it so that if I get stopped out, it's going to be within my allotted risk per trade. So the max risk per trade, the max risk that I really want to take is 1% of equity. But in reality, I really run about 30 basis points to 50 basis points of risk. So what that means is, you know, if I buy a stock and I get stopped out, it's going to cost me about 0.5% of my total account equity. So if that's the case, if I got stopped out 20 times in a row, which doesn't happen, but even if I get stopped out 20 times in a row, it's going to cost me 10% of my account equity, and I can recover from that. So that's the key thing, is I go in, I assume I'm going to get stopped out. Once my positions start to work, so generally once I'm up about 10%, you know, assuming I'm up 10% or so in a position, then I'll look to move the stop up, maybe to break even, or at least cut my risk in half. So that if I want to add a new position, what I want to do is reduce my risk somewhere else, so that I'm not just adding new risk and new risk and new risk. Because if you do that and then you get the rug pull, right, then you take a pretty big hit. So generally when I add new positions, I look to take down my risk somewhere else, whether I book some gains, move my stops up. Just the other day I've got 18 open positions right now. And the other day, I think I moved up the stops on maybe 10 or 12 of the open positions. So most of the open positions right now are over break even. We've taken some gains. So there's not a lot of real equity risk in there. So then this way I can add, you know, more risk, but it's something that I look at every single day with every single trade.
No, I love that, and because risk management is everything, and I wanted to bring that up because when I see somebody say like I need to run a very tight stop loss, the first thing I think of is like, one, you're probably trading way too big.
Yeah.
If you're trading that large, that like a little wobble is gonna like wipe out your portfolio, that's a problem. The thing that and it's interesting because if you actually are ever on like at a prop firm or some form of trading floor, you'll see when traders have trouble, the biggest thing they do is go cut your position size in half.
Right.
And then when they're going through another losing period, they'll go, well, cut your position size in half again. And that's the thing, like retail traders, they don't really know because they're like, oh, well, I have this great idea. I want to put all my money into it because I'll make all the money in the world tomorrow, and then everything in my life will be okay. And it's like, no, that's not how it works. It's a game of putting the risk to reward on our side, putting probabilities on our side, and then taking the trade, and also making sure we're managing our risk properly. Like Larry said, 1% of the portfolio. Steve, a good question for you is when you're doing that type of risk management with options, this is something that I'm sure a lot of the people watching want to know about. So how do you risk manage with options if you're buying a call or buying a put?
There's
Or even
different
selling.
One way is to simply know that the premium that you paid to get in that option is the maximum amount of money that you could lose no matter what the hell happens. So that's risk management right there. Options have an inherent, element of risk management in them. Another thing that we do is when we're in short dated calls, usually, if you get a double, you sell half. And what you're doing there is you have a free ride. So this week, we entered a position on DraftKings a week or two ago. Just little short-term continuation pattern resolution. It's March Madness. I liked everything about this trade. We got in. It worked for us right away. We sold the double, right? Completely, a little bit more than a double, right? So take half off. You still have like a little gain, even if the rest goes to zero. And it's pretty much going to zero here today. Then we're not hurt, right? So for us, it's you don't win, you don't lose. So no harm, no foul. That's one way to do it. But there's different ways. Options also for me are just like a kicker or a cherry on top, right? I'm already long the common, but I want a little bit more juice. I want a little bit more leverage on this. Okay, let's add calls or something. It's usually that sort of a situation.
No, I like that, and I think the thing that we do, we take very rare. Do we buy options? It's very rare, but if we ever do, it's just 1% of the portfolio. Like Steve said, there's that inherent risk management built into it. So I know I'm only going to lose 1% of my portfolio if the option goes to zero. I know, in the back of my head, hey, this trade can go to zero at all times. I think so many people use these options in a different way where they're like, okay, I can grab all this extra leverage. I have, this amount in my account. I'm going to put it all in these options. It's a very bad idea. And I've watched a lot of people blow up over the years on that. So I just wanted to cover that for a second. So getting back into, and either one of you guys can answer this, getting back to risk management a little bit. When we're talking about position sizing, how exactly, let's cap it at $100,000 portfolio, making an easy number. How do you size your positions inside of that $100,000 portfolio?
So if you want, I'll start with that one because, I do a lot on position sizing and what have you. So it comes down to a couple things. I think the first thing is how much overall risk does somebody want to take? So at any one time, the high side for me is 10% of my open equity, and it's usually much closer to 5%. But it comes back to stop placement. So here's the thing. Let's say I want to risk 1% in a trade, right? I could take in $100,000 account, I could put $20,000 into a stock and run a 5% stop. It's 1% risk. Or I could put 10 grand into a stock with a 10% stop. It's still 1% risk, right? I could put 5 grand in, 20%. So there's a couple different ways to size it. So it's really based on, how much overall risk does someone have and how confident are they in this position. So if I had 100 grand all in cash, right? And I'm just going to buy one stock, maybe I'll put 20% into that one stock and run a 5% stop. But if I'm running 10 or 15 stocks at a time, I can't put 20% into one. So I would say the very basic, at least for me, when I teach this to, friends, family, whatever it is that just want some basics, I would just use the, a 10 and 10 rule. 10% of my money into a stock with a 10% stop. I'm risking, 1%. And I think that's the simplest way. I'm not a big fan of tight stops. And, maybe because I'm not a shorter term trader, but, I'll go online sometimes and see people that are, getting into high beta stocks like Super Micro or Celsius or something like that and running a tight stop. I mean, Super Micro has about a 9% ATR, right? So if you buy Super Micro today,
Crazy.
the average daily range on Super Micro is $90 a day. So if you're running a 5% stop on a stock that trades in a 9% range, you buy the stock here, you put your stop here, just in the daily range, it could hit your stop and take you out. So, at a minimum, I would put a stop in a stock that's 1.5 times the ATR, because the last thing I want to do is buy, Super Micro or Nvidia or Micron, put in a 5% stop. They're going to hit it unless you get it exactly right. They're going to hit it just in daily volatility. You donate your money to the market, and then the stock goes up 20%. So tight stops on like these IBD types of stocks and Super Micro and AI and Marathon Digital, which has a 20% ATR. You got to be careful, because if you're a very active trader in super high volatility stocks, tight stops are really just a way to get stopped out a lot and, miss on a lot of trades. So you really have to look at the volatility and try to put and that might mean a smaller size. I'd rather take a smaller position, put my stop somewhere that makes sense on the chart, and try to avoid that, the market maker just picking me off, every single day, and have I'd rather be right in a smaller position than be wrong in a bigger position.
Yeah. I want to use like a key polarity level, right, as my stop, and then a cushion below it to allow for some sort of shakeout or whipsaw at that key level that doesn't take me out. Another way to do it is just know that the market's going to try to shake you out, and get long something with the idea in mind that I'll probably get shook out of this, and I'm okay with re-entering it and maybe getting stopped out once or twice or even 3 times before it finally works and I get that breakout. Because I'm going to keep my stop so tight, I'm going to lose so little that I could keep swinging at this setup. Because I get very annoyed when I'm either shook out of something, or if I'm stopped out and then it goes and I'm not in it. It's like, for me, psychologically terrible.
Yeah, I hate that. That's the worst.
Right.
And it's happened to me. I got stopped out of Super Micro, and then it went, so it's, yeah, that's a tough one.
I'll think about it for the rest of the year. It's not healthy.
Yeah.
So I'll try to put a nice cushion in below a very obvious level that I know the market's going to try to hit, right? And then build something a couple percent below there, and just anticipate the shakeouts, because they are so common. And you tend to get them right before the big moves, right? We say, I think it's Brian Shannonism, from failed moves come fast moves. You see it all the time. Usually that shakeout is literally like the beginning of the rally leg. So
yeah, Steve, you just used a term there which I've never heard before. I think it was key polarity level.
yes.
What do you mean by that? How do you figure out where that level is?
Well, a lot of times people would say, oh, it's a resistance level or it's a support level. I like it when it's both. Right? When it's resistance that then flips into support, it's really a polarity zone where the market, and you can see it, you should be able to see it very clearly on a chart, the market is telling us over and over and over again, hey, this level's important, because it's reacting at it, right? Whether finding resistance or finding support there. So if I can, let's talk again about one of these nice rounding bottom breakouts. Square is the example again. If I'm getting long at 90, right, because that's the polarity level where I think the base is complete and a new uptrend's underway, then I might put my stop at 85, 86, whatever it might be, because I know the market's going to try to hit 90 and maybe even 88, right? So I want to have some sort of wiggle room below there. But then you have to be careful, because it has to be a loss that you could take on, right? If you're going to build in a cushion, it can't be too much. Some of these high pay can be.
I like that. Very, very well, good explanation. And also, there's something, just one more thing to add, which is, I love the way you guys put this. Larry also adding on to it. When I have something like Bitcoin, I tell people that in our portfolio, Bitcoin has a trailing stop of 35%. And they think I'm making a joke most of the time. But really, Bitcoin has a trailing stop of 35%. So we have to, even if that $100,000 example, to make it an easy number, if we have a $10,000 position, even that's too big. So we have to continue to take that position down even more so. So I think it's, and also the most important thing to me always is my back test. If I'm back testing and it tells me that, hey, if I'm running a 10% stop on Bitcoin, I'm not going to make any money in this system. Or if it says I'm going to run a 35% trailing stop and I'm going to make the same amount of money in this system while hedging my losses at the same time, that's going to be the stop loss I'm going to use over everything. I don't care about my opinions or feelings, but that's taken a long time to get there. So as long as you really understand, hey, like Larry said, take your position sizing down. This is something that is the hardest thing to do as a new trader, but it's the most essential thing to do. And then, because stop losses are terrible if you're trading them too big or trading too big and your stop loss is too tight. So I love the way you guys answered that. It's a great question, or great answers, guys. So, man, we're getting a lot of questions from different people about Larry. This is kind of funny because as a technician, you're probably going to have a very funny answer to this one. Andrew probably already saw it too, but what's Larry's darling stock? Everybody has a darling stock.
Oh, it's Nvidia by far. Hey, you gotta take the prettiest girl to the prom or something like that, right? But no, Nvidia. So Nvidia has been one of my favorite stocks for I don't know, the past 5 or 6 years. Coming out of the hole in 2020, we caught a really nice trade with Nvidia. Got shaken out of it a little bit in 2022. Got stopped out a few times, but we got back into it May of last year in the 280s and have been, holding it, adding to it since then. But I think Nvidia is the real deal. I've done, a ton of research. I've got some videos that are out there. But, I lived through the dot-com bubble. I was actively trading 98, 99, 2000. I know what a bubble looks like and feels like, and I don't see a bubble in Nvidia. It's 30 times forward earnings. They're projected to grow their earnings something about 70% this year. They've got a pretty big, wide open, addressable market. But on top of all that, the chart has just been lights out. It's been in a straight up trend, 4 rising moving averages. The stock has not gone up as much as the earnings have gone up. So if you think about that for a second, if stock prices generally follow earnings, the price appreciation in Nvidia has not gone up as much as the earnings have. So FinViz says that Nvidia's earnings, and I'm just looking at this off the top here, Nvidia's earnings have gone up over the past 12 months, 586%. The stock itself has gone up 238%. So the stock price is now they're not going to continue to grow earnings at 535% year over year, but at a 30 forward PE, they don't need to. It can obviously correct, at some point because stocks can't go up forever. But yeah, and Nvidia that's my go-to. It's been working for us. I've been buying it on the pullbacks. I've been buying it on the breakouts, and as long as it keeps working, we're gonna stay with it.
This stock gets cheaper every time it reports earnings and gaps up by 20%. It actually gets cheaper on like a PE basis.
Yeah,
based valuation metric basis.
Yeah,
and even if it is a bubble, does that mean that you have to pay your gains back when it's all said and done? Or
yeah,
right?
Yeah. And listen, when I started in 2000, I just did a really big study on this, right? But at the top, Cisco's PE was about 160 or something. The NASDAQ composite itself, the PE at the top was 170. So the entire NASDAQ composite in
Not the
March of 2000, the PE was 170. It's like 40 right now. So there's no bubble. You know, just because the stock has gone up a lot doesn't necessarily mean that it's a bubble. When the NASDAQ 100, I think the NASDAQ 100 is up 10% higher today than it was in November of 2021. You know what I mean? So it made a high, it got, you know, taken out to the woodshed, and then it's come back up, but it's 10% over the high. But yeah, Nvidia for me, they've got the sales growth, they've got the earnings growth. The chart is just been phenomenal. And, you know, we're going to stay with it as long as it keeps working.
You know, back during the .com bubble, correct me if I'm wrong, but weren't most tech companies still just like not profitable at all?
Absolutely. The tech bubble was really, it was stocks with no earnings. You know, for your IPOs, at the top you had Cisco and Intel and Microsoft. Those were real companies back then too. But your IPOs, and then under your top 10 real stocks, you had a bunch of companies that had either no earnings, a lot of them had no sales, a lot of them traded at 200 times earnings. And I mean, Supermicro's 35 times, you know, forward earnings expectations, and, you know, on trailing, and that's another stock, you know, it's 79 times trailing. So it's definitely not a cheap stock, but they're also growing their earnings at 80%. So it's, you know, I think that, you know, I'm a believer in AI and the AI stocks. And I do think, and a couple other people have said this, but I do think that we're closer to the 1996 part of that entire move from 95 to 2000 than the end.
Right.
And you saw this with Oracle's earnings recently. You saw this with Micron Technology's earnings. I mean, all of their earnings beats are coming from, you know, AI and from AI forward, you know, guidance. And that's where it is. So yeah, Nvidia, but Nvidia is not, you know, it's a wild stock. It's going to be up $50 and down $50 from day to day.
So that's an interesting answer. So as a technician, when something has gone up and to the right and has made you a lot of money, you love the stock.
Yeah. Hey, you know what?
That's
We're gonna ride the horse that gets us there. You know what I mean? It's like we were talking about football before. And if you keep handing the ball off to the running back and he keeps scoring a touchdown, what are you going to keep doing? Keep handing the ball off. And then if that stops, then, you know, then you reevaluate. But, you know, and really anything in semiconductors, I think if you're looking for, you know, high upside, you know, people that are looking for high upside trades, you know, Micron's been super strong. WDC's breaking out. They're not in semis, but they're close enough. AMD, you know, when you get AMD right, it's, you know, up 30%, down 30%. But AMD, I think it'll probably stabilize here. And then once it turns back up, you probably get a nice big move out of that too.
What you're saying is dance with the one who brung
Yeah.
you.
I mean, why reinvent the wheel? You know, and I used to do that a lot when I was new. I would, you know, have a stock that had been working really good. And then I keep looking for a new stock and a new stock and a new stock. But sometimes the, you know, the best stock to buy is the one that's been the real workhorse for you. And,
Yep.
you know, that's the way I see it. Just, you know, don't reinvent the wheel. The market will tell you what's working. And when it stops working, then maybe, you know, you reevaluate. But Nvidia has been over the 50-day going back to last November. If it, you know, so that's the answer to the question.
No, I love it because I mean it's a thing that we do as traders when we're especially it's like, you know, it's very hard for people, and this is a conversation that's come up a lot lately, is when you have these situations in markets and like let's say you see some other stock crashing. Nobody wants to buy Nvidia right now, for example. But everybody would buy something in a downtrend day after day after day. So it's kind of interesting to see, like, you know,
yeah,
your mentality and Steve's mentality of like, hey, this is moving very well. I really like this. It's doing great. These are the reasons why it could be working out. I don't really know 100%. I know the trend is up, and I know we're riding and been making money for a long time and well into profits. Because you really just don't know when a trend will end, you know.
Right.
So I think that's great.
I remember people
well said,
when
guys.
I bought Nvidia, you know, at 280, people were like, you know, why are you buying the stock at the top? You know, it was at the top at 280 and it was at the top at 480. And to Steve's point, the industrial sector, because not everybody wants Nvidia. You know, there's 11 sectors in the market, but these industrial stocks are great. You know, the chart trends: General Electric, Caterpillar, you know, Eaton Corporation, Vertiv, VRT, anything that's tied to the infrastructure build out. There's a lot of stocks: HUBB, which is Hubble, NVT, which is nVent Electric. These stocks train TT. This industrial sector is super strong.
Yep.
You know, and for those, you know, now granted, Caterpillar is not going to move like Micron, but you know, for people that are looking outside, and you know, Steve brought up materials. You know, the steel stocks have been really strong, Steel Dynamics, and there's just, you could pick any sector and pretty much find, you know, quite a few really strong breakout charts, if not more.
That's right. There's pockets of strength in just about every sector. You just find them.
There's
Also,
utility stocks that are up 70% year to date.
yeah. Yep.
Yeah, any sector.
Another thing I would just add to that is absolute charts trend. We know that. Markets trend. Another thing that trends is ratio charts. The relative trends themselves trend, right? So periods of outperformance or underperformance will come like waves, right? And you can ride those relative strength or relative weakness trends if you want to be, if you want to short, you can ride them in the same way that you would ride an absolute price trend. Absolute price trend. Larry's talking about Nvidia. It keeps working. So we just keep going back to the well. It keeps leading too, right? You look at Nvidia relative to the broader market. It's been a leader for a long time. So you can ride out the relative trends the same way that you ride the absolute trends.
No, I think that's perfect, guys. Andrew, do you want to wrap up here?
Yeah, sure. So I haven't had much to say today. It's been great to sit back and listen to you guys. My trading style is very different. I'm an algorithmic futures trader, so it was great listening to you know, stock traders and guys of your caliber. It's given me lots of ideas, so thank you very much. Now, Jason, how do we wrap this up today? Do you want to start first with how people can get in touch with you or learn more from you?
Yeah, so if you guys want to check my stuff out, we do have a YouTube channel. Andrew put it in the link, so you could check out the new interview we put out with Tomas. It was really good. And then also, you know, AAO research on everything. We have a Substack channel for a newsletter, AAO research on Twitter, Facebook, or Instagram. Anything you pump it into, it'll come out. So I'd love to hear from you guys. Feel free to ask any questions. Steven, go ahead. How can people get in touch with you?
Yep. You could find my charts every day on my Twitter at Strazza, or on the allstarcharts.com blog, or on Stock Market TV on YouTube, or you can get there from stockmarkettv.com as well.
And Larry.
Yeah, everything for me is at Blue Chip Daily. So my website is bluechipdaily.com. And then on Twitter and YouTube, the channel is at Blue Chip Daily. And that's really Twitter. I'm most active on Twitter. I'm pretty much on Twitter every day. I've been on there since 2013. You have a lot of fun, great interactions with people, have some great conversations. And I post there every single day.
Excellent. Well, thanks everyone for joining us today. Now, I just remembered actually that Jason, we need to talk about a potential change of times, because the time zone here in Australia, I know you guys in the US have changed already. We change this weekend, I think, so we need to have a look. So I was going to say, come and join us 2 p.m. Eastern every Wednesday. It may change next week. We'll have to look at that, and we'll let everybody know. So
yes, we will let everybody know. So,
sounds
good.
Exactly.
This was fun, guys.
Yeah, thanks for joining us, Steve. Thanks, Larry. It was great.
Yeah, great
Andrew,
meeting.
Jason, thank you so much for having me on. I really appreciate it. Steve, it was great to meet you online. Great conversation with you guys. I really appreciate it.
Yep.
Excellent.
Thank you.
All right. Cheers. All the best.
Bye, guys.
Bye.